For those of you just logging on, we're going to get started in about a minute. Just waiting a few more seconds for people to join. Welcome, everyone. My name is Julia Sad. I'm the marketing manager at Softrax. I would like to welcome everyone to today's webinar, the Top 5 ASC 606 Implementation Challenges and Surprises. On behalf of Softrax and Baker Tilly, I'd like to thank you all for joining us today. Just a few quick items before we get started. Softrax is registered with NASBA. Attendees of today's one-hour session will be eligible to receive 1 CPE credit. In order to receive the CPE credits, attendees must participate in 3 of the 4 polling questions and must attend the entire presentation. A post-webinar evaluation survey will be sent out via email after the webinar, and a recording of today's webinar will be made available as well. We'd like to encourage you to submit your questions via the questions box in your GoToWebinar control panel. Today's speakers will do their best to get to your questions, but if we do not, a speaker will follow up with you directly after the webinar. Today, our revenue recognition experts from Softrax and Baker Tilly will be discussing the 5-step process of the new revenue recognition standard, the top implementation challenges, key issues, and transition methods. It's my pleasure to introduce to you today our first featured speaker and revenue recognition expert, Philip Santarelli. Thank you, Philip, for joining us. Philip has years experience in the industry and is serving as a CPA for Baker Tilly, one of the top 15 largest nationally recognized accounting and advisory firms in the U.S. and the world's 9th largest accounting and consulting network. We also have our second speaker. I'd like to introduce to you today Softrax's very own Jeff Halden. Jeff is one of our solution advisors here, and Softrax is a leading provider for revenue recognition software, helping enterprise-level companies automate complex RevRec requirements. And Jeff works with Softrax clients on revenue management issues and demoing Softrax Revenue Manager product. Jeff, thank you for joining us today.
Thank you, Julia.
You're welcome. To start off our webinar, we're going to start with our first polling question, and I'll hand it over to you, Jeff, as I pull that up.
Okay, great. Well, welcome everybody. Excited to be here and to have Phil and the Baker Tilly team with us. So let's just jump right in, and we want to find out from all of you in attendance here where you are in the process of adopting ASC 606. You know, A, fully prepared, B, working on systems and business rules, C, in the assessment phase, if you will, D, thinking it really doesn't apply too much to you, or E, just hiding out as long as you possibly can. We'll take a minute while we capture those responses. And Phil, this is a question that we commonly ask in our webinar series, I'm always surprised how many companies are in the assessing mode or really haven't gotten that far. So I'm going to place my bet that there's going to be a lot of, C's, but what do you think?
Yeah, I would agree, Jeff. All of the surveys that we've been seeing still have a lot of respondents that are uncertain about the impact, are in the kind of an assessment phase. And really for public companies at this stage of the game with just under 4 months to the effective date, being in the assessment phase is going to put an awful lot of pressure on those entities from the standpoint of their accounting department, their IT department, their internal auditors, and so forth. So as we notice here, 52% are assessing the impact, and it's getting a little late for that. They really need to be up in the first two bars. Now, if you're a private company, I think, and you're assessing the impact, then you're ahead of the game, and that's a good thing. So, but this is not uncommon what we're seeing. Yeah.
Yeah, I guess we don't know the breakout of companies, but seeing that 82% in the second and third there is still, it's a big number to be, considering where we are in the calendar. Sure is.
Yeah, time is going, and of course, public companies at this particular time of the year have a third quarter close coming up, and everybody's got a day job, and resource constraints are common in the companies that we're working with, and I think it's going to apply across the spectrum, frankly, because this is it's going to be a big lift for most entities.
Right. Okay, we're going to start off in terms of our topics today with an overview of the guidance, as well as the timeline and the 5-step framework. And Phil, we're going to ask you to lead us through it. So let's just get to the next slide and turn it over to you.
Okay, thank you very much, Jeff, and hello to everyone. Thanks for joining us. So ASC 606, revenue from contracts with customers, was issued by the FASB in May of 2014. So it's been over 3 years since the initial issuance, and it was issued as a convert standard. That means the International Accounting Standards Board also adopted a standard that's effectively the same as ASC 606, and it took 10 years of work to get there. So the current state of play is that, as I noted, for public companies, the standard becomes effective January 1st, 2018, which will mean that the first reporting period for public companies is going to be Q1 of 2018, which is less than, a little less than 6 months away, a little bit more than 6 months away. For everyone else, there's a year more to 2019. So for private companies and most not-for-profits, there's an additional year. I will note that for large not-for-profits, typical hospitals, higher education institutions, if they are conduit debt obligors, they actually have the earlier effective date. So if you're a hospital with a calendar year end with a conduit debt, you start on January 1 as well. And the overriding thing to keep in the back of your mind, what is one of the main challenges with this standard, is it's a principle-based standard, meaning that there are many more judgments and estimates than are typical for U.S. GAAP preparers. Typically, one of the criticisms about U.S. GAAP it is historically been very rules-based. RevRec being one of the most rules-based. Current standard ASC 605 is supported by hundreds of pages of industry-specific guidance, and 606 was designed to get everyone on a level playing field, and we'll see where that goes. Next slide.
Yeah.
So here we are for the next slide. So, and Jim, go ahead, Jim.
Just one question, maybe before we move
Sure.
on. We know, or at least we assume, there aren't any plans or whispers for changing any dates at this point, but there was a fairly recent adjustment for PBEs, the private companies that meet that public business entity definition. Was that more
Correct.
a comment about their readiness, or maybe one more about their materiality in terms of who they roll up into, or what was that about?
My guess is, not to speak for the SEC, and you're correct, that guidance came out in the last 6 weeks or so to provide some relief on what are defined in the standard as public business entities, but actually do not file, they're not registered with the SEC. They're entities that may be investees of public companies or entities that were acquired by public companies. And in some cases, those entities need to prepare and file financial statements along with the related public company. They're not subject to PCAOB audit rules. It's a U.S. gas audit, but they, under the rules as written, they're subject to SEC accounting rules, and the FASB scoped them in. But that, it was determined by SEC, and appropriately, I think, is that it's just very burdensome. And in some situations, it's not uncommon to have certain equity method investees get scoped into a public filing kind of at a late date, that they don't really understand or know that they become a material investee for the public company. And in those situations, it would be very, very difficult for a non-public entity that was going along under current GAAP to adjust on the fly. So I think the SEC did a good thing, and I don't think investors are going to be disadvantaged by that for the additional year. So it was a good break.
Right. Okay.
So let's just go back one slide, Julia, if you would. Just if you can, yeah. Just so, and you know, hopefully you've heard of this. The people on the webinar have heard this, but 606 sets up a 5-step framework for evaluating revenue recognition. And the 5 steps, we'll get into a little bit more details, are identifying a contract with the customer, identifying what are referred to as performance obligations, determining the transaction price, allocating that transaction price to performance obligations if there are multiple performance obligations, and then finally recognizing the revenue. And the standard lays out an approach in each one of those steps that really needs to be followed. And there's been a lot of talk about, and entities have disclosed this, that the impact of the standard is not material. And what they're saying there is the measurement, that they've done an assessment, and the measurement of their top line number is not going to be materially changed as a result of 606, which is not particularly surprising across a wide spectrum of companies. However, the method that they arrive at that measurement is changing substantially, and they will not be able to just say, well, the answer is the same, we can keep doing it the same way. That just won't be acceptable, and we'll talk about that a little bit more later. So let's go to the next slide, please. Okay. So briefly, we start with identifying the contract, and contracts can be written or oral common business practice, and really they're defined as an agreement with enforceable rights. The parties have evidence of being approved. One can identify what the goods or services to be provided are. The payment can be identified and has commercial substance. And then a key point, which we'll talk more about later, is that collectability is probable. Okay, next slide, please. So the second step is, so we've got a contract, let's figure out what that means for us. And the second step is to identify what are defined as performance obligations. I think anybody getting into the standard for the first time should pay close attention to the glossary in ASC 606 because the boards created a lot of new terminologies which are defined in the glossary. And if you read the standard, generally bold-faced terms mean they appear in the glossary for the first time. So a performance obligation is simply a promise to transfer goods or services. These can be discrete or a series of services which are the same. So if you clean an office building every day, that's a performance obligation for that series. There are explicit and implicit promises. And one of the key factors is for where there are multiple performance obligations, determining whether that promise is distinct. Okay, next, please.
So one comment though before you move forward. You know, this is an area that we see a big impact where companies are really still trying to understand what all the performance obligations are that they have. Many that they didn't consider, you know, even something that you might think was being done, separating out support, for instance, or understanding a future right or an option, things like that. I mean, is this going to be a big milestone for companies just trying to identify what all they are?
Yeah, for certain industries, depending on the complexity of their contracts, many industrial companies, aerospace and defense companies, software development companies, a lot of those shops will have a difficult time separating these performance obligations. And even if you're familiar with multiple element accounting, it's not the same thing exactly. In fact, there was a recent SEC speech by a member of the Office of the Chief Accountant that cautioned entities that are used to multiple elements, or they use the terminology deliverables, that deliverables are not necessarily the same as a performance obligation, that they can't assume that, they've got to go through the analysis. So it can be very complex. For other businesses, retail in particular, it may not be particularly complex. Many service restaurants, those types of things may not be particularly complex. Hospitality industry may not be complex, but there are nuances. And the other thing is this concept of implicit promises, where if the customer has a reasonable expectation that the entity is going to provide the good or service, whether it's written down or not, it counts. And this is where the accounting department will need to get deeper into the organization to understand what the sales people are promising, what is a habit of the operational people, et cetera. And one of those is implied warranties. A lot of companies don't have a stated warranty, but if something breaks, they have a history of replacing it or free service, those sorts of things. So it's going to be a bit of a challenge. And companies have to go through the exercise to make sure they capture them all. So,
yep. Okay. Great.
All right. So now we have the performance obligations, and we have to consider the transaction price, and it's defined as the amount of consideration an entity expects to receive in exchange for the good or service. The concept of variable consideration is brought into the standard. Many contracts really have variability to them. They can be for discounts, rebates, refunds, performance bonuses, etc. And that variability now has to be considered up front and when determining what that transaction price is. And then another twist here is that for entities that have long-term contracts, typically there isn't a practical expedient. If the contracts are fulfilled within a year, you can opt out of this. But if you have long-term contracts and there potentially are pricing differences between paying cash on the barrel, as it were, or deferring those payments, that might be a financing component. And that can be in either direction, where the entity is providing financing to their customer by permitting the customer to defer payment, or vice versa. The customer is making an upfront payment to the entity, which could be considered and is considered as a loan to the company and creates interest expense, or in the reverse, the first instance would be interest income. The idea there is that different entities in the same industry may have different business models with respect to deferred payments or receiving upfront payments, and the idea was to get a pure revenue number, and things that were akin to interest income or interest expense would not be in those numbers. So that's going to be a challenge if you do long-term contracts. Again, many businesses won't be a consideration at all.
Yeah, I mean, just to interject there, we've developed a lot of functionality around the financing component, and you really do see some odd accounting. I mean, unusual accounting, as you noted, because you're looking at both sides of that transaction, and you may be, effectively grossing up in some sense to account for that interest element carve out.
That's absolutely correct, and it also has an element where it may only apply to certain performance obligations. Doesn't necessarily, it's not applied at a contract level, it's applied at the performance obligation level. So it's quite possible that entities surprisingly will end up with financing component, and in that case, you'll create a contract liability, and in fact, that whatever you're calculating as imputed interest will be recorded below the line versus in the revenue line. And that, interestingly enough, changes your statement of cash flows, because it is in effect as a loan, the cash flow related to that is a financing activity versus an operating activity.
Right,
so
right.
It's a little deep for this seminar, but it's an issue for certain companies. So,
well, just thinking about too, variable consideration and knowing how big of a change that is, along with the requirement to update that over time. I mean, do you think companies are just going to sort of lowball that so that they don't ever, run into the situation of overstating revenue in the earlier period?
That could happen. However, FASB, the boards did not think that would happen. In fact, they really leaned the other way, that the companies would recognize too much revenue based on the variability. And so they added a constraint to that an entity cannot recognize revenue that is has a probability of being reversed in a future period. So FASB, and I believe it's an anti-abuse feature. So I think you may have some companies that will be conservative, but it depends on the pressure of the marketplace and what the expectation is for earnings per share. So you could see people trying to push the envelope and then have to consider that constraint. On the private company side, again, my guess is they'll be more conservative and not take in the plus side of the revenue. But who knows? But that's a great question. But the constraint on variable consideration was FASB's way of limiting that, and frankly, you're not supposed to lowball it. You can't default to the lower number. You've got to go through the analysis.
Yeah.
So, okay.
Hey, so we have a question on this topic. I wonder if you want to try to tackle a question from the audience as we go here.
Oh, sure.
It says, my team is working on the analysis for transition, struggling with the variable consideration component where you reduce revenue by the amount you do not expect to collect, due to price concession, rebate, et cetera, right? Well,
right.
Exactly what we just talked about. The question then is, does this do away with the reserve process because you'll be adjusting the transaction price and thus reducing revenue?
No. The short answer is no. So the way the standard is designed, an entity has to make a good faith determination on variable consideration and what they expect to receive. And after having done that, and recording accounts receivable based on, or contract assets and potentially accounts receivable based on that variable consideration, if there's a future change related to credit issues, then the allowance for doubtful accounts comes into play. Then companies will make a reserve. Okay, now there's a nuance there that's different from changes in the variability of the consideration, right? So if they thought they were going to get a performance bonus, and they determined that they are unlikely to get the performance bonus and thus reduce the transaction price that they've been using to recognize revenue, that would not be a bad debt issue. But if they felt they were going to get a price without any price concessions or anything else, and then later on the entity that they sold to had credit problems, that's bad debt. So that concept is still there. Okay.
Yeah, you're still going to value.
Again, that's a complicated. It's one of those judgment areas, Jeff, which is complex. How you arrive at that, and we'll talk a little bit more about that when we get to in a couple of slides when we talk about contracts in general. So let's get next slide, please. Yeah. And I believe this is fairly straightforward, allocating the transaction price. So assuming you have multiple performance obligations, you've got a transaction price that's been determined. That price has to be allocated over those multiple performance obligations based on standalone selling prices. Entities that are used to multiple deliverables will kind of understand how that works. And again, it only applies for multiple performance obligations, and there's methods within the standard for how to determine standalone selling price. And it's a way that the discounts, if there's a discount, that discount is applied to all the performance obligations or allocated proportionally. Although there are situations where discounts may be for just one. Again, I don't think it's going to be particularly complicated, and more entities are used to it. So yeah, let's go to the next slide. So then finally, we've done all the allocations and we're teed up to recognize revenue. Of course, all these decisions somehow have to be stored in the accounting system and be able to be referenced when it's time to recognize the revenue. And the concept here is control passes to the customer, revenue is recognized, and customer control is extensively defined within the standard, and what the indicators of control and so forth are is not necessarily title transfer, those types of things, but there will be judgment on control. And then the third box there talks about two methods for recognizing revenue. One is at a point in time. So retailer sells a good, collects the revenue, that's point in time revenue, collects the cash for the good, that would be point in time recognition. The retailer would recognize it at that point. If you don't recognize point in time, over time is the way it's done. That's similar to what contractors are doing right now. They have a long-term contract and they recognize revenue using various methods today. That'll carry over in the standard a little bit, but what we're finding is that, and I'll talk about it on the next slide, there's this over time issue is surprising many entities, including many of the entities that we've been working with providing consulting services. So those are the five elements. Yeah, go ahead.
I was going to say, quick question on the control issue then, Phil. I mean, for those companies that sell through a channel, are they now making estimates of that future consideration instead of deferring, until it's sold through the channel? Is that the plan now? Well, it depends on who the customer is.
If the customer is the channel itself, the wholesaler, then that contract is with the customer, and what happens downstream is not relevant unless, and this is where the variable consideration comes into play, unless variability is created because of agreements with the wholesaler as far as sell-through goes. Okay? So that's where sales return rights, those sorts of things, refunds and so forth enter into variable consideration. So the
Okay.
starting point is always who is the customer, and your analysis is there. But if in fact there is a sell-through element because of the customer, so if you're a manufacturer selling to Walmart, Walmart will pay you for what they sell through on a general basis. If they don't sell through at Christmas, it's coming back to you. So that's variable consideration. You're going to have to make an estimate and reduce the consideration for that variability. So that's how that's going to go. But you got to focus on who the customer is. So we got the 5 elements, and I've identified on this slide 5 what I think are which will be challenges and or surprises when applying 606. The first one is the collectability issue. Now, we talked about that briefly about this. Under current GAAP, generally collectability is not assessed at inception of the transaction. If you have a sales transaction, you book an account receivable and credit revenue, and then over time, after time, one evaluates what the need for allowance for doubtful accounts and handle collectability that way. This standard changes that significantly. Now, in order for an entity to actually start the process of recognizing revenue, they need to make an upfront determination that there is a probability that the amount that they expect to receive for providing the good or services will be collected. And probability means in U.S. GAAP typically 75% plus. If they can't hit that threshold, then a contract does not exist for 606. And even though the entity starts to perform on it, they start to perform it, they collect any funds, all those are hung up as a contract liability, and the entity continues to revisit that contract to see if facts and circumstances have changed to where they now believe collectability is probable. If so, then contract is valid and they can start to recognize revenue. So that's quite different. The second thing is the concept of performance obligations and identifying whether a performance obligation is distinct, and that'll be pretty straightforward, but it's also got to be distinct in the context of the contract. So while some promises could have standalone value to a customer in the context of a contract, they may be linked to other performance obligations, other promises that are made, and then in fact those are combined for purposes of allocating transaction price, et cetera, and revenue recognition. That's possibly significant and could result in deferred revenue. In other cases, maybe where an entity has been deferring revenue under current GAAP, they may find that a certain performance obligation is distinct and they can front load the revenue. The variable consideration will be tricky. There's 2 methods for doing that. One is the expected value method, which is a probability weighted approach, which will be complicated and difficult to apply. And then the other approach is the most likely amount method, which is, and it's not an accounting policy decision. Facts and circumstances have to drive which one you use. Allocating discounts and variable consideration to specific performance obligations rather than proportionally could be justifying it and making the call that, hey, for this performance obligation, we're offering the discount, and for the rest, get more of the assigned revenue. And then finally, this revenue over time. One provision for recognizing revenue over time is if an entity is producing an asset that has no value to it, to the entity itself, and is entitled to payment if the contract for effort to date, if the contract is terminated, that would generally qualify for overtime revenue recognition. So we're finding some, and say a tier 1 manufacturer for the automobile industry, if they're making a unique part for General Motors, and General Motors restricts the use of that, General Motors for some reason cuts the contract short, they can't do anything with those assets, with those parts that have been made. A lot of those companies use point in time now. When they deliver it to GM, they recognize the revenue. Under this standard, they may have overtime so that they can recognize, they may accelerate some revenue. We'll see. Those are a couple of things that we're seeing in practice. So, okay.
Okay, great. I think we're going to move to a polling question. The next topic. So let's move to some of the concerns with the new guidance. And so for those of you with students, this is an SAT level question, multiple choice. Which of these issues is concerning you as you prepare for adoption? Understanding performance obligations, allocating and recognizing revenue, contract modification issues, disclosures, and internal controls. Any and all. Let us know where your concerns are. And while we're waiting for that, those are some big issues right there, and we may well still have people with concerns for all of them. Any speculation on what you see most commonly?
I think that many of the entities we're dealing with, and we're struggling with the assessment and trying to get their hands around the measurement aspects, and really had pushed the internal control issue to the side. And for public companies, that's going to be a problem. It's a problem for any entity. Obviously, control is important, but for public companies, ICFR is a big deal, and SEC has been talking about it, making speeches about it, and catching up on ICFR, I think, is going to be challenging.
Yeah, and it looks like the results sort of show that out, internal controls being the bottom of the list, so to speak.
Exactly.
Allocating and recognizing revenue right up there at 57%.
Sure. Yeah, not surprised, and that's when we start our consulting engagements, that's where everybody's at, and we try to, and of course you've got to go through that part of it, but I think the fact that so many are in that concern, that's telling me they're in the assessment phase, and we've got to accelerate. Okay,
so we talked about performance obligations, allocating revenue, and let's move on to some of the next big areas.
Yeah. Right. So
go ahead, Phil. Maybe we'll move ahead to the next.
So
I was just going to note that, obviously the general goal is to provide a thorough view of current potential users of financial statements, revenue, and cash flow, but there are a lot of other areas impacted, and and a lot of disclosures to deal with. So what are your thoughts here on sort of priorities and how to get your arms around all this?
So I think one of the maybe one of the goals that the boards had in creating this standard was really to improve transparency around revenue recognition. Under current standards, most disclosures related to revenue recognition are fairly generic across industries. They're generally a paragraph or two in Note 1 to the financial statements that kind of parrot the same things. If you read 50 Rev Rec footnotes, half of them will almost use the same words. And therefore, the users were not getting much information on really how the entity generated the revenue, where it came from, what was the sustainability of the revenue, what are the cash flows related to the revenue. So the disclosure requirements, and it was one of the, not necessarily surprised, but we were waiting for it when it came out, are really robust. And so we'll show you a little bit more detail, and then after that we'll talk about the internal control issue. So we go to the next slide. As you said, Jeff, this is a quote from 606. This is the objective is understand nature, amount, timing, and uncertainty of revenue and cash flows, and that really it entails or imparts in the definition the concept of forward-looking information. That in fact users will be able to look at those disclosures and in fact make some decisions on what will happen in future years. Not to say that there's any element of prospective financial information, but there are indicators there that can enable users of those financial statements to potentially draw some conclusions about what's going to happen in the future. So moving to the next slide, and I kind of say this often, although 606 is a principle-based standard, there are a lot of rules when it comes to disclosures. So for public entities, public companies, and this also applies to those not-for-profits with the conduit debt, which may be a surprise to many of them, these are the required disclosures. There needs to be a disaggregation of revenue in a way that's most meaningful for the users, a reconciliation of contract balances, that means accounts receivable, any contract assets, contract liabilities, capitalized contract costs, that changes, not just the table that goes from A to B, but in fact, what are those changes? What happened there? Information about performance obligations. What are the nature of the performance obligations that an entity has? And then what are the remaining performance obligations to be completed at the end of any financial reporting period? So commonly referred to as backlog. So many contractors are used to giving backlog disclosures, but now it'll apply more broadly. There is cost guidance in the standard. Entities now have to capitalize certain costs to obtain contracts, and information on that has to be provided. Those first five are all quantitative disclosures. And then number 6 is a catch-all, and they're qualitative disclosures. And what the boards were trying to get at there is, because there are so many judgments and estimates in this standard, tell us about how you arrived at those judgments. How did you determine whether you're a point-in-time or over-time recognition? How did you determine whether there was a financing component? How did you determine variable consideration? Those types of things. So you're supposed to get some insight into the thinking of management and the preparers on how they arrived at the numbers that are presented on the financial statements. So this is much, much different than you'd ever see in a set of financial statements today.
And
go ahead.
The ones that we tend to hear, in terms of systematic solutions for these challenges, really the first two, the ability to disaggregate in multiple ways, of course, is important, at least as a starting point for companies to be able to, start to prepare those breakdowns. And then the account roll forwards, the contract balance roll forwards. We do hear, of course, number 5 as well quite a bit, typically more in the context of, this is something new we need to be able to do that we haven't done before, capitalize those costs, amortize them in different ways. So it's more of a transaction processing need, but clearly these are all things that we're hearing as well as a solution provider to companies are concerned about.
Yeah. Well, and a lot of the information that they're going to need to do these disclosures is not necessarily located in the general ledger or in the accounting department, particularly when it comes to remaining performance obligations and other information about performance obligations. That may need to come from other departments, operations, sales departments, etc. And I describe it as, I think there's going to be a bit of culture shock there, because they typically have not been subject to internal control over financial reporting. So now the finance and accounting department is going to have to reach out, have systems to gather that information, and of course all that information, the accuracy of that information is going to be audited, so it has to be subject to internal control over financial reporting. So many organizations are going to be challenged by that because they're just not going to have the information in their general ledgers or in the accounting department.
Right.
They may get a notice that we've done something, send a bill to customer X, but all of the remaining performance obligations may or may not be sitting in the accounting department. The contract may not be sitting there, and now all that analysis and record keeping has to arrive in accounting and finance in order to get into the disclosures. Lots of judgments. So, okay, next slide, please. We'll move along a little bit quickly as the time goes on. Public companies have some relief. They're noted here. I won't go into a lot of detail over it, but the boards did provide, at least the U.S. board provided relief for non-public companies. International does not. Non-public companies internationally have no relief. Okay, and so just the next slide. I think we discussed it, but it's going to be a more demanding process. Internal control has to be there. All of those disclosures are audited, et cetera, and lots of significant judgments. So I think we can move on to the ICFR area. So internal control over financial reporting, recent speeches, as I mentioned, by OCA. SEC is very concerned about this. And for public companies, the PCLB recently put out their inspection plan for 17 audits, and one of their bullet points is they're going to evaluate what the auditors did in 17 with respect to the issuer's plans for adoption of revenue recognition. You know, I have no direct knowledge, but that bullet point to me seems to maybe have come from the SEC, an SEC suggestion, because I've just seen a lot of talk from the SEC. They're very concerned about the internal control aspect. So lots of judgments, estimates, all of those are going to require some sort of entity level, top level control. As I said, even if the answer doesn't change, you're going to have ICFR that reflects the 5 elements. And today, many companies just really aren't prepared to do that. And I think what's going to happen, they'll probably have to continue to record the transactions as they have traditionally, and then go to offline analysis to get to the numbers that they need to record adjustments. So, and that, of course, presents its own internal control challenges. So if you download into Excel files, is the information accurate and complete? Those sorts of things. And the other issue with that, and we'll speak to it in a moment, is the transition, which is also subject to internal control. So auditors will have a lot more work to do, and management does as well, to come up with stuff. So we can continue. So just, nothing new here, but the COSO framework should be applied to these transitions, including risk assessments, having competent people that understand the standard running this program. SEC, everybody's been talking about that extensively. So companies really need to consider that to make sure they have the right people trying to handle this transition. Go forward, please. We talked about that, SOX, robust controls, yep, etc.
Yeah, let's move to our third polling question.
Yeah.
Yeah, and the question now is, what tools and techniques are you using to help out in your adoption? This one is, not a multiple selection. So you need to pick the one that best represents your approach here, relying on current systems and processes, developing new rules, processes, and workarounds. Maybe you're looking at an ERP modification. Maybe you're implementing new applications and seeking new processes and systems to build into the organization. And so I'm hoping it's one of the last ones so that people call us, but
yeah.
they may be still in this assessment phase and need more of your help as well.
Absolutely. Absolutely. I think many ERP systems are going to be challenged, and they'll need help from companies like you as well. So
we have certainly seen that. Yes.
Yeah. Yep. Expect to rely on current processes. Yeah. So, all right, let's move on.
What does that mean? Spreadsheet workaround?
Sure. Yeah, I mean they're going to have to. They're going to have to. That's at least in the near term. But that'll be too much of a pain point, and there'll be expectations of automating that process as we go forward. So briefly, just a couple of more points. 2, transition method, full retrospective, and modified full retro is for public companies restate 2016 and 2017. For the modified, which is not necessarily a picnic either, is entities would account for 606 obviously in 2018, would not change the accounting for 2017. So side-by-side comparison of prior period as presented with the new accounting in 18. In order to do that, a cumulative effect change would be done as of January 1st of 18 through retained earnings. And then if you use that method, you're required to provide disclosure of for every line item affected by adopting 606 and 18, what that amount would have been under 605 in 2017. So neither of them are particularly fun, but I just saw a survey of the Fortune 500, and currently about 57% of the Fortune 500 have determined to use the modified. 11% are going full retro, and there's still 32% that haven't decided. So next slide. Some of the considerations is the level of effort. The transition, as I said, will be considered by auditors. There's an expectation really that's been there since 16 that SAP 74 disclosures would be discussing this, what the transition method is and so forth. So if you haven't done it yet, you may want to consider doing it with this quarter that's coming up, Q3, if you've made the decision for sure. We do know of comment letters going out from the SEC complaining about lack of transparency. Next slide, please. And then, as I said, you may need, if you're doing the full retro, you may need some parallel records for 17 and going back to 16 as well, which is a significant level of effort. And all of that will be subject to audit as well. All of that will be subject to audit as well. So from the standpoint of the audit effort, external audit effort, probably modified is going to be a little easier. But if you go full retro, the auditors are going to be we'll have to look at all of the numbers in the restatement. So, and I think we can skip to the fourth polling question, Jeff. Yeah, there we go.
Yep. Yeah, let's make sure people get their CPE credit. Yep. We need to do 4. So, which approach are you planning or planning to take, at least as you know it right now? Just one answer, although I suppose you could be both unsure and unclear. But Phil, I would think at this point there has to be more clarity than what we've seen and read. I just read one Big Four survey, which is a recurring survey, and they suggested that 50% were still undecided.
Yeah, the one I looked at this morning this is only the Fortune 500. Okay, so you would expect they're going to be most furthest down the line on this, even in the Fortune 500, 32% are undecided or not disclosed, which is to me the same as being undecided. So that's kind of remarkable for the Fortune 500. So because they've got the most sophisticated accounting departments in the land. So imagine what the other 10,000 issuers, where those numbers are.
Yeah.
So,
okay, let's pull those results up and see. Okay. Well,
okay,
that's a bit unsure and unclear.
Yep. So, in concluding on this, just some final comments. This is a real drive-by as far as the information you're going to need. There's a lot of information out there. Baker Tilly has an ebook that you can get to give you a better overview, but get some help. Let's go to that last slide, Jeff, if you want to comment on that.
Yeah, I mean, I think we know that what we continue to hear is that many companies are behind, and I think you also have to consider how stretched the auditors are, and there certainly are risks of misstated revenue and incomplete disclosures. So, I think we would all say, get help, call us, call Baker Tilly, and let us know how we can assist in the process.
Yeah, absolutely. I mean, I think those risks on that right-hand box are very, very real. That entities that are not ready, remembering that Q1 of 18, 606 has to apply. Although those are not audited to financial statements, they are subject to your auditor review. And if they come up in the course of that review determine that the revenue is not jiving with 606, that could be a problem. It could lead to disclosures about material weaknesses or significant deficiencies, certainly remediation. I think me personally, as an auditor, are expecting trouble with internal control over financial reporting just because of the state of play, and I think the SEC is. And frankly, I think if they don't see the ICFR comments, they'll be surprised. And that's never good. So we'll see what happens. But time is short, as they say.
Yeah.
And I just like, I see just a reminder that questions, would be happy to field any questions. Just send me an email or Jeff an email, and we'll try to respond as best we can.
Yeah.
Well, thank you, Jeff and Phil, for speaking today, and thank you everyone on the line that was able to join us. Again, here's Baker Tilly's information if you want to reach out to them for any advisory and consulting services. And we also have Softrax's information up here. If you're looking to learn more about our software, feel free to reach out. And as Phil said, we will be answering any questions directly that came in that we weren't able to get to today live on the webinar. And a copy of the slides, an evaluation survey, and the recorded webinar will be made available. And CPE certificates will be emailed out within 2 to 3 weeks after the webinar. But we want to just thank everyone for attending today's presentation.
Great, thank you. Thank you, Phil. That was awesome.
Thank you.
Hope to do it again, and appreciate everybody's time today.
Good luck to everyone. Bye-bye.